Good afternoon. Today marks the second episode of our series on navigating today and tomorrow for business owners and professionals. In this episode, we are delving into a critical aspect corporate taxation. For business owners and professionals, understanding and planning for corporate taxation is paramount. It requires intense consideration, regular review to adopt to ever changing tax landscape. If you have not already, I highly recommend watching our first episode on building on a solid foundation on our series. Let's delve into complexities and strategies of corporate taxation together. Let's get started. As I indicated earlier in our series Navigating Today and Tomorrow for Business Owner and Professionals, our topic of conversation is changing nature of corporate taxation. So this is a very vast topic. I'm going to try to do my best to indicate few main points to consider, but and it hopefully it starts some conversation, and then hopefully it's helpful for you. So the number one thing we have to consider, the tax planning for business owner was relatively simple, and there was no limit on passive income, no limit on dividend to adult children, dividend to spouse and common law partner. There was no there you was able to dividend your spouse and common law partner. No small business deduction grind based on the type amount of income. So there was nothing of those things existed. And since the new tax rules came into the picture in 2018, many of the clients have been asking this question, that all these things, there is any benefit to incorporating or not. Historically, business owner incorporates in order to protect shareholder from creditor and liabilities of the business, because the corporation is a separate body and entity. So from the shareholder point of view, legally the liability of the shareholder is limited to their investment in the corporation. So many, for many businesses, however, incorporating for creditor protection is not entirely effective anymore. Some shareholder must provide personal guarantees for the loan they're getting for their business. For professionals, the legislative governing body, which if you are a doctor, or if you are a dentist, if you're a professional, hold individual professional liable for the services and advice related to the practice of their profession. So that something, the credit protection is there. The corporate structure only provides protection against the claims of the trade creditor. So though that is something, we has been changed. For many business owners, the primary motivation of incorporation is tax deferral. So the tax deferral is and tax saving, and that is the main thing. A lot of time we are looking for the credit protection for the incorporation. Liability and credit protection is not in not in a main thing, you the reason you incorporate. In general term, the tax benefit of incorporating having include tax deferral, income splitting, and capital gain exemption on the sale of your practice. So when you are incorporating, there is three main benefits you have. Number one, you have a capital gain exemption. Number two, you have some income splitting availability, which we will talk further. And number three, you have a tax deferral, because and that we will discuss in our coming slides. So after June 24th to 2024, so as of this year on June 24th, every Canadian has a lifetime capital gain exemption, which is $1,250,000. This exemption is indexed to inflation. However, exemption can only be used for the shelter gain on certain type of property on which the qualified small business corporation share, which is called which qualify a small business corporate share. So there is a criteria that must be met to share to qualify for QSBC. So number one thing, the 90% of the assets of the business has to be involved in active business. So the example is this, that if your business value is 10 million, 9 million of that value has to be in the active business. It can't be in passive assets. It can't be, the 3 million cannot be sitting in investments and a bank account. That will offside you for QSBC small for a capital gain exemption. The second thing, 2 year prior to the sale, 50% of the value of the asset used to earn income from the active business. So that is the second thing. So that's something to build up the passive income asset in a corporation can block. So if you're building up a very big passive income portfolio inside your corporation, that can affect your eligibility for QSBC. Therefore, it is necessary sometime to, like, you have to purify your opco to make sure that you are on site for QSBC eligibility. And also you can multiply your QSBC, if, like, capital gain exemption, if to by introducing or bringing your share, giving your shares to your family member. So that's something can increase your availability for QSBC. So in the July 18, 2017, the revised the TOSI came in picture. So TOSI is tax on split income. That changed the corporate taxation and the tax planning for business owner and professional drastically. Like, it had a huge impact on it. So TOSI income paid by the most often in form of dividend and other income. So TOSI applies to non-salary income paid by the private corporation, most often in the form of dividends and other shareholder benefit. The revised rule do not impact the payment of salary that are reasonable and on reassessable what would be the pay to a third party to do the same work. So if you're paying a salary to your spouse and for a certain amount of work which you will pay somebody else in the market, and that's out of TOSI, it is fine. Instead, TOSI rule seeks to limit income splitting with people who are 18 and older. How this is accomplished is a far from straightforward. It's a very complicated thing to go through. Under the TOSI rules, all dividends paid to the adults age 18 and or older who are related to the shareholder will be taxed at top personal tax unless certain conditions are met. So if your dividend will be taxed at the top rate. These new measures also include more rigorous tests of shareholder age 18 to 24. They essentially require young adults to be actively engaged in the business on a regular and continuous basis. So, and to have contributed their own capital into the business. So that's something it is a so now we're going to look at it that, okay, how the TOSI rules are are translated. So first is the reasonable return exception, and those are the exceptions we're going to look at it. The first is the reasonable return exception, where the family member receives what is deemed to be reasonable return on the capital they have contributed to the corporation. For the people between age 18 to 24, a reasonable return will be depend on the source of the capital they have contributed to the corporation. If the source of the capital contributed is not from an arm length source, such as a gift from a family member, a reasonable return must not exceed the prescribed rate of return. So the prescribed rate as of Q3 2024 is 5%. The result is to be very limited opportunity for income splitting. And when the capital contribution is from an arm length source, these individuals can use the reasonable return criteria used for the people who are age 25 up. So for individual age 25 years or older, reasonable return will be based on comparison of contribution made by the related shareholder to the business made by looking at the following factors: work performed in support of the business, property contributed in the support of the business, risk assumed in respect of the business, and other relevant factors. So those it is quite intense. Now, in most instances, the spouse and the children of the business owner have only paid a nominal amount of for their share in the capital, have not provided a personal guarantee for the business. That what this means in practice is that in many instances, a reasonable return would be dividend equivalent of the reasonable salary for the work performed in a business. So basically, dividend, you can pay the dividend, but it will be equal to the reasonable salary for the work performed in the business, meaning the potential benefit of associated with income splitting is very modest. So in simple, that if you are paying the dividend to you can pay the dividend, but it has to fall into the idea that okay, it will be the equivalent to the salary you will pay for the work they're doing. Now the other side of the story is this, that okay, so it, it, like the if the individual is 25 years and older, excluded share exception may be applicable for amount received on and or from excluded shares. Share will be excluded share if individual own 10 or more percent of the votes and value of the corporation. Corporation was not a professional corporation, so it can be a doctor, dentist, or accounting practice or financial advisor. The corporation business income was less than 90% from the provision of services, and 90 or more percent of the income of the business is not from another related business in respect to the individual. So the last grade is meant to prevent company like professional corporation, which I indicated earlier, from paying rent to non-professional corporation in order to shift income to a company that is not excluded under those rules. So again, as I said earlier, TOSI rules are not straightforward. The actively engage exemption can present much better opportunity for income splitting for many business owners. Where family member is actively engaged in the business for a corporation, the TOSI will not apply. There will be no restriction on amount of dividend can be paid for this exemption to apply. The following factor must be met. So these are the following satisfying criteria. Family member must be 18 years of age or older, and the family member must be actively engaged in the business for the corporation on a regular basis, continuous substantial basis on the current year or any 5 year prior taxation years. So those are the things. So what does that mean? What that mean to be actively engaged in the business on a regular, continuous, substantial basis? Family member is deemed to be actively engaged if they work on a business at least average 20 hour per week. So if your business, they are working in the business 20 hours a week. If this exception is satisfied, there is no further limit on the amount non-salary income that is dividend can be. There is no limit how much dividend can be paid to the family member outside of the TOSI rules. So that, if you are able to satisfy it. The final exception is the age-based exception, and TOSI rule will apply when dividend and other non-salary income is received by the business owner spouse, or business owner is 65 years of age or older. So what that means? So in simple sense, that if your spouse should be a shareholder of your corporation, even you are not able to pay her any income through any, you cannot do any income splitting. But when you cross 65, there you are able to pay her dividend, and which will be on site, and it will give you on income splitting opportunity. The reason this exception is available because it will align the corporations with the exemption which is available on income splitting in registered assets for outside of the corporation. So it aligned those two things together. Then, and I think so that where the reason comes in, then even the spouse is not getting the dividend and she's not involved in a corporation, she should be a shareholder, so there is some income splitting opportunity of in retirement. So as I have said, in primary motivation of a corporation is access to low corporate tax rates. That applies to income from active businesses, depending on what province you are in, technically in which province the income is subject to taxation. General rate of taxation of active income range from 23 to 31. In Saskatchewan, the small business limit tax rate is which is income under 500,000 is around about 10%, and it's supposed to go up slightly in 2025. Active income is earned by Canadian controlled private corporation from business carried primarily in Canada. So The first 500, as I indicated, will be taxed at a small business rate. And after, in Saskatchewan, 500,000 get at a small business rate. Between 500 and 600,000, the rate goes up, and after 600,000, general rate comes in. So which and the small business rate is generally lower, is much lower, and it gives you the ability that if you have money which you do not need, and so why pay a tax and pull that money out of the corporation and invest it personally? Why not just keep that money more inside the corporation and invest that money inside the corporation? And that deferral opportunity adds up over the year. So in this slide, the very simple example, if you salary, if you have $1,000, your personal income become $1,000, you pay the tax at the top rate, you have net income of $500 left. If you have a corporation, if we assume in Saskatchewan, here we are assuming 12% tax rate, but if we in Saskatchewan we assume you earn $1,000, you don't need that money, you pay $100 tax, you have round about $900 left in your corporation if you are under $500,000 in income. So now we're going to talk about a very interesting topic, which is a very big discussion on called small business grind. So we already came to the conclusion that the small business deduction, the tax rate is much lower than the general tax rate. And if you have a lower tax rate, you are able to accumulate more and build bigger assets and defer that taxation liability to further down the road. So when originally announced the new passive income rules in July 2018, government made it very clear they wanted to reduce and eliminate tax deferral currently was available to private corporation retain active business income and invest those funds corporate in passive investments like ETFs, pooled fund, mutual funds, stocks, real estate, all those. The new rules tied the amount of small business deduction limit, currently $500,000 federally, to active income, and which is a tax at a lower rate. So $500,000, that passive income, to that $500,000 limit. So what it is that if you have passive income $50,000, then at that time your small business deduction is not affected. At 150, that amount, that small business deduction, is totally gone. It is grinded down to zero. So reducing, given the like, and the other thing you also have to be careful that that small business deduction and that grind applies to corporation and all group of corporation together. So all this, it applies to your full structure. So in this chart, we're going to get a little bit in depth about the small business deduction grind. And we're going to get a little bit more in depth so it can be a little bit explained a little bit properly. So if you look at this chart, that for example, if the person has um, small business, if your business income is 250,000, corporate, and the corporate has 100,000 in passive income, before the income, there is no grind on it, because after, if you take that $100,000, it's going to bring down the it will bring down the active business income to 50, and there is no grind, and the business income is 250. So that 250 is taxed on a small business tax rate. When the passive income is 150 and more, as I indicated, the small deduction is not available if a small business is gone, because that passive income cross 150, your small business deduction is totally gone. Ultimately, the small business deduction ultimately results in a tax payment versus an additional tax cost. So it's not a tax cost, it's a tax payment, because when you are paying the general tax rate, you have the ability to pay eligible dividend, and we are not going to get into that. It's for a later discussion. So because the time passive income is paid, the shareholder and tax are paid at both at a corporate and personal level, the total amount of tax paid is pretty much the same. So you're not paying more tax in when you're getting what I'm trying to say, when you are paying the tax at the journal rate, you don't have a small business deduction anymore. It's not like this that you're going to pay more tax. You're paying almost the same tax, but your deferral is gone, because the tax that you're paying tax at the journal rate. So there, that increase in tax, your ability to defer more income is goes down. That where the grind is really affecting. So so we can start by, like, we can, if we really want to protect the small business deduction and have that, preserve the deferral, we can really look at few strategies which can be considered to help out. So number one, shareholder loan. If you have loan owning to a shareholder, can be repaid to share tax free. There are outstanding shareholder loan, it would be generally make sense to distribute that money to cash to shareholder as much as fast possible. Also, you have to consider that corporate passive income is taxed differently than your personally, that same income is taxed. So in general, it is you are is benefited, that it is beneficial that if you have a shareholder loan, you take that money out and invest it personally. Capital dividend. So a capital dividend account is a notional account which tracks the non taxable portion of capital gain. And so if I always advise, is sometimes it's become, people don't pay attention. If your capital dividend account balance is 10 20 thousand dollars, just pay it out. If you don't want to pay it out, write a promissory note. Why promissory note? If cash is not available, so at least it's paid out, because that capital dividend account amount will go down if you have a capital losses declared in any coming years. So recovery of refundable dividend tax on hand, so RDTOH. So although we recommend not paying taxable dividends, just to avoid the grind, if that's not the reason you should pay the dividend, but if the refundable portion of the corporate tax on investment income and portfolio dividend has been allowed to accumulate in a corporation, there may be no net additional tax cost to pay the taxable dividend. So there could be even some net tax recovery to pay the taxable dividend. So it is, if you own a Royal Bank share and they paid you a eligible dividend, that dividend is taxed pretty. Is a Canadian controlled corporation, is an eligible dividend. It can be, you have a better chance to get that income out. So there's other planning opportunities that can help to minimize the impact of passive income. Could we have small business, including portfolio construction? You can construct the portfolio a little bit to optimize the taxation opportunity to enhance registered saving. I'm a very big believer of using all pillars of planning. You should have, I'm not you should have registered account, you should have CPP contributions, which give you another source of income in your retirement, decrease your risk in your retirement. Not all assets should be left inside the corporation. And permanent insurance can help you to build money inside the corporation up to a certain amount. And also it can increase the value of your estate. It can pay off the taxes which are due at the last death. So looking over an investment portfolio to both corporation and shareholder, we can align those portfolios and put different form of income in different places. We example, if it's aligned with the client risk profile, we can put more interest paying instrument in your registered account, and put eligible dividend paying stocks and capital gain based investment in your corporation. Today I also firmly believe the paying salary, if you pay as compared to going 100% dividend, you should pay your salary. That salary will create a T4 income, and that will create your registered account room, and you can contribute to RSP, you can contribute to IPP. You are creating another source of retirement income, and it decreases the uncertainty into your retirement life. So those things are very important. So there's a number of strategies we can think and talk about it. So if this topic of taxation, as I indicated, is a very vast topic. We already touching around about 20 minutes in this episode, and I will be surprised that if people are still interested to talk or listen to taxation topics more. Please, if you find this interesting, share with somebody, and I really appreciate that. And if you have any questions and if you have anything in mind, please pick up the phone and call me. I'm always happy to have a chat. Have a wonderful summer. Talk to you soon.